Hi. As the budget comes closer, the market starts to set their expectations and each one will have their own set of views. But given the fact that we are a financial planning and a wealth management company, we will share our perspective from capital market outlook. Now, I have stated this earlier. If you measure the GDP of a country using the expenditure approach, the formula is Y, that is GDP, equals C, that is consumption, plus I, which is private sector investment, plus G, which is the government sector investment and spending, and finally is plus X minus M, that is net export, export minus import. Now, if you actually look at the current situation, post-COVID, for a easy monetary policy, inflation rose very drastically, and that led to a situation where things started becoming expensive. Now, over the last few years, there has not been significant job increment, salary increment was muted, and inflation was very high. To add to the misery, the monsoon was not very good. This all things added up to slowing down consumption in the country, meaning people were consuming less, and in rural areas people were looking at cheaper substitute. They were cutting down on the quality of consumption. This led to a slowdown. Now, how did the companies react? The companies initially increased the price of the product. So you will see over the last few quarters, all the consumption oriented companies, their top line or the revenue growth is muted or limited, but the earning growth went up. So the margin increased. But beyond a point, it is difficult to keep increasing the prices. It will destroy demand. Hence, you are seeing a lot of these companies struggling with the earning growth in the last 2-3 quarters. Now, moreover, there is no private sector investment, the second wheel of the vehicle, because most companies are sitting at just 75% of the capacity, meaning if they have a capacity to produce 100 product, they are currently producing 75 or less. So there is no incentive for them to further expand capacity. So given the current situation, what could be the expectation from the government? Simply, now there could be a lot of long-term measures for job creation and all those things, but the need of the hour is immediate solution, and that can come from direct tax cut, which would lead to higher amount of surplus in the hand of consumer, thereby increasing their marginal propensity to consume. That will give boost. And if that consumption and private sector investment are also interlinked, if the consumption goes up, capacity utilization goes up, it is then the private sector company will start setting up new capacities. So this is the first expectation from the government. The second, if you actually look at over the last few years, it is the government which is shouldering the responsibility of GDP growth. The government expenditure has been very, very high. But over the last 2 quarters, there is a sharp decline in the government expenditure, thereby slowing down the GDP growth of the company. Hence, the expectation would be that government will have to resort back to their stance of supporting with higher capital expenditure programs. This is the second expectation. And the third and the final expectation is, the government has consciously walked the path of reducing fiscal deficit. Now, it is a very tricky situation right now for government as well as RBI. If they create a very easy monetary policy and try to fuel growth fast, that will lead to higher inflation, and higher inflation will mean that the rupee will weaken. So the government and RBI will have to actually play the balancing act. And what's that balancing act? They have to address the growth issue and also ensure that there is some balance for managing fiscal prudence. So when you manage fiscal prudence with growth, it means you have to address growth query, but in a very controlled manner. So these are 3 major expectations from the budget that we have from capital market perspective.